No.
Great. Well, thank you, David. It's a pleasure to be with you all, and always fun when we're talking about indicators. I've put a lot of my energy over my 30 years of stock and options trading into finding the best indicators that give me the best advantage. I want to share with you one that you won't hear talked about outside of big trends, and that's what we call big trends bands. So I'll enlighten you on how I use that to target up to 300% gains in my Grand Slam options program. Just a reminder that, of course, everything that I share with you here today is for your information and education only. Nothing we talk about here should be considered a specific recommendation of buy or sell any particular investment. Of course, you know that you are 100% responsible for your own investment decisions. Big Trends and the staff are not responsible for any trades you choose to make, and not all Big Trends products and services are appropriate for all traders and investors. BigTrends does not provide any personalized financial, tax, or legal advice to any individual. What we do instead is we take our research, send it out in real time, email and text alert, so our subscribers can then act on it as they see fit. As always, consult your tax advisor on anything that's going to impact your tax situation. So I've been trading for 31 plus years. I got started in 1990 after graduating from Duke University, made the classic early mistakes of thinking I knew it all, and had a real perfectionism problem of not letting go of trades that weren't working. So really, that took me a couple of years to get over, I got to admit, in my early days of trading. So if you've been there, I can relate. And the bottom line is that you just have to get a systematic approach. Everything we do at Big Trends is based on time-tested research and strategies. We've got to have an edge. It's got to be proven over many years, bull and bear markets. So I started Big Trends in 1999 and was blessed to be inducted in the Traders Hall of Fame back in 2007. We've been also blessed to serve many, many thousands of active clients. So, it's baseball season, and thankfully we're getting back to a semi-normal, and hopefully we stay there. People are worried about this Delta variant. And there will always be worries out there, whether it's COVID or whether it's economy or whether it's inflation or interest rates. But the key is you got to let the indicators tell you where the money is flowing. And so what I do is I use the indicators. I'm going to walk you through especially a focus on the big trends bands here today, but also the ADX and the CCI are the three legs of the stool in my Grand Slam strategy. Well, when all these start to signal at once, I buy these options priced at a buck or less a contract. So, when we think about the baseball analogy, a buck or less a contract means you pay no more than $100 to control 100 shares of stock. So in the baseball terms, I don't want to shoot for singles, the first base, hit. I'm not after small gains with this strategy. I'm saying, you know what? I want at least a double. Okay. I don't always get it, but when I get it, then we'll talk about how, if it doesn't work, what we do to get out. On 100% gain, that's a double on your money. You know that. I sell half of my position is exited there. So I take half out at 100% gain. What does that do? If you invest $1,000 and in a typical trade, you're up to $2,000. Well, then if you sell half of that position, so you got 10 contracts at $100 each, those are up to now $200 each, or, you sell 5 of those 10 at 2 apiece, that's $1,000 back. You get your original risk capital back in your pocket when you sell half at a double. What I find is that doesn't reduce your risk and give you the proverbial free trade. It also gives you a lot more psychological freedom and emotional freedom to give the trade a chance to keep going. What you've probably found in your own trading, if you've traded for a while, is that your best trades tend to be right for the start and often can go a lot better than you would expect. Whereas the trades that, when trading is easy, that's when you're trend following and riding that move. When trading's hard, you're fighting the trend. You're not listening to what the market's telling you. Like I said, it took me a while to start learning to listen to the markets and not just what I thought. Okay, so listen to the markets, the money flow is the true tell of what's happening here. So what we want to focus on here is, okay, what's going on with our next position at a quarter at a triple? That's the third base in the baseball terms, 200% gain, triple your money. We sell a quarter of our original position, half of our remaining half. And then the final target is a home run, clear the bases, 4-bagger. We make 4 times our money. That's a 300% return on your original investment. We sell our final quarter of the position. So we go double, triple, quadruple is our goal. Like I said, we're not going to always get it, but those are the ones that carry your portfolio. Then you just got to manage the rest so that they don't kill you. Now, and we're going to talk about gamma. We're going to talk about other elements of this aggressive option strategy. It's definitely high growth, and we've got to manage the risk along the way because these are out of the money options. So what I'm talking about with big trends bands is actually a spinoff of what you see down here with my friend Larry Williams. He developed this indicator called the percent R. Okay, so this is the basis of basically saying, are we in a range? Percent R means percent range. Okay. It implies that you're in a range. When you hit the quote overbought peak of that range above the 80th percentile, that should be the top of the range. The 80th percentile here is the blue line. Okay, so if I write the 80th percentile here up here, 80% within the last look back range, whatever time period you want to look at. All my subscribers get all my customized settings for every indicator when you get on board. But the principle is, okay, look, it's on the verge, and you kind of have a question mark here, like, is this thing breaking out through the top of that range? How do I answer that question? I answer that question by saying, let the institutions prove to me that they want to keep buying it above this first overbought bar's high, and it's got to close above that overbought bar high the next 5 days or less. So you notice that it doesn't get through there on the next day, and it tries both of those days, but it does not close above there. Those red candles show you that it failed, came back into the range. So by not confirming, that's still the top of the range. So that's actually still a range trade. It's certainly not a trend trade yet. And so the next question mark comes up here. A lot of trading involves questions, right? You get the percent R going over bottom. This next one here, you go question mark. Is this the start of a trend or not? And I say, I don't know. Let the institutions prove it to me. On the next candle, notice what happens. It comes back below that, and you say, okay, well, if it's an X, then do you go ahead and turn off the trade? No, because look what percent R is doing. It's still a check mark. It's still good to go. It's not coming back under that 80% line like it was on the prior setup. It's staying above that big trends band. Now, the big trends band is the conversion of the idea of the percent R and saying, you know what, if it's staying above that 80th percentile, that's telling you that it could be the start of a new trending phase. And so my confirmation is a close above there, which you can see here is closing above there in a big green candle. We'll put a C by it. That's confirmed. Okay. So at that point, where do we buy? We buy the very next bars open off of a daily chart close. And I do this on daily charts. I even now do it on some intraday charts, so we can get intraday signals too, as well as beginning of the day signals. So I buy right there at the start of that candle. And the reason I point out on that red candle is that first day I was negative after day one. Okay, so that one was not working for me. But on day two is where I'm ringing the register, and we're getting a double and a triple after just two trading days. Actually, the third trading morning, so we got our 300% gain. Technically on this chart in at about 48 hours from 2 mornings before. But the point is that, okay, how do we get paid on this strategy? Look where the stock was when we got in. The stock, AMD, of course, Advanced Micro Devices, one of the now leading tech names, big chip name overtaking Intel, was about $62 when we bought it. And what do we buy? That was the prior July, actually. AMD was trading around 62. We were buying the August 75 calls about a month out till their expiration for $1. You say you're buying 13 points out of the money and you're paying $1 for that. That means your break even is 14 points higher at $76, right? That's true at expiration. But our break even before then, with a month to go, is a lot less. Obviously, we're getting paid before the stock even hits up. It barely got above 70 when we cashed out of our last piece. It hit to about $71 when we cashed out of our last 300% profit target. Just a few days later. So the point is, when those things are lining up, and by the way, the ADX, which we won't spend as much time on here, we want to talk more big trends bands today, is one of my favorite, especially unique indicators, but ADX, another great tool. This blue one here is CCI. So we're going to talk about all those pieces today with the focus on the big trends bands. So the big trends band shows you that even when we were wrong that first day, it's still kind of hovering right at that 60 level, right at that big trends band support. It's still suggesting that it should hold there. In the old days, I would just look at the percent R line and say, well, that's a retest of that 80% level. So when that retest happens, then you say, okay, that's a level that should hold those test points underneath there. If we're in a confirmed bull trend, the prior one, we weren't. So we're going to go on and show you more examples, but I say, why should you care? Again, I'm always reticent to talk about past performance because it doesn't guarantee future results, but you can see that even on a small account, it can help it grow it quite dramatically through a lot of different market environments. We're not going to be in the market every day. We're going to pick our spots. We can get in, get out relatively quickly in a matter of a day to 5 days is a typical kind of a sweet spot for us. But we can't even hold it longer if it's working. We haven't gotten our targets yet. So a $5,000 model portfolio would have grown to $22,865. That'd be a $17,000 865 profit. This is gross profit before commissions. As you know, commissions have come down to next to nothing for option traders. So you should not be paying a ticket charge anymore. You should be paying less than $1 a contract. If you're paying more than that, you should be reaching out to get some input on brokers you might consider to get your commission costs down to next to nothing. But it's really a beautiful strategy, and I'll talk about how it's done here even just recently. But the point is that, okay, like here's another example, Moderna. And some of our newer subscribers, when I made this recommendation back, this was in, you can see late April, and Moderna, by the way, just had another huge move. The options I thought were actually too expensive on this latest move, but it turned out to have a great move this last week. But you know what? We caught the Moderna mRNA as a symbol vaccine maker May 230 calls. We bought them for $1. So remember, the whole principle of options is that you're literally buying an option on something that can explode and go dramatically higher in a relatively short period of time. So when I recommended this name, actually intraday, it was about $168. And intraday, it went up about 10 points up here to the high to about 178, almost to 180. Of course, everything was still all systems go on the indicators. You can see this one had already broken out of the BigTrends bands. The one that came in a little bit later was the CCI, the bottom panel. Especially on a shorter CCI setting. But you see, if you're just following the going over bot signal here, we were really officially crossing it on the BigTrends bands right here. And we're really confirming right here. And you see it had to go through this retest. You see it held the 80 level on this red line right here. But this is the retest bar right here. This retest, that low has to hold, even when it has that brief dip back into the BigTrends bands. I don't bail on it unless it breaks that low. You see it didn't. And then we look at how we held and kept going. But intraday, it popped 10 points in those 230 calls we bought at $1. We're able to sell on that same day. We're not day traders by nature, but if I get my double in the same day, I'll say, thank you very much. Let me sell half my position. The other half ended up kind of just fizzling out to a smaller gain, and maybe we averaged 50 or 55% for the whole trade. But the point of this is that, that's why we sell half at a double, because if it doesn't go, you even when you sell part of the position at the other half at break even, you're still averaging a 50% gain on the trade. That works pretty nicely. So beauty of this is that, okay, you can see everything staying overbought, and it kept on grinding up. Now this chart, you can see we had a chart. This is from April 21st to June 21st. The portfolio had been up about $2,090 in profit on that model $5,000 portfolio just in that past 2 months. And then I had my associate JP help me update this, and I want to show you the result through the close on Monday was growing even more here. So check this out. You see that this slide has gone up from 2,090 here to 3,499. Again, past performance is no guarantee of future results, but that next month, if you waited, you can see you left at 3,500, you left almost $1,400 on the table by waiting a month. Right now, I'm not saying every month's going to be like that. Some are going to be better, some are going to be flattish, or some are going to be givebacks. But the key is if we can manage the risk and be around to help grow a portfolio. Think about that: a $5,000 portfolio at $1,400 would be pushing into the neighborhood of about a 28% gain for the month. So I have a lot of coaching students who say, can I achieve 5 to 10% gains a month? And I say, absolutely you can. But you have to know what you're doing, and you have to manage risk. We're going to talk about managing risk here. So past performance, no guarantee that could be better or worse in the future, but we're committed to, with my 30 plus years in the game, always getting better and better and learning more and more, and also about not just how to make money, but also how to not give it back. That's a big part of it too. So here's a name you may not know as well. It's Macerich. So Macerich, MAC is a symbol. This has been one of those like tied to the real estate names where, of course, a lot of those names were pummeled in the pandemic as everything shut down. And so Macerich, we got a signal on it. You can see that I didn't plot the BigTrends bands on this one, but you can see that we were already in %R way overbought and staying overbought. Through this whole phase, when you go back and look at moves that you missed, folks, you'll probably notice that overbought can stay overbought, and you go, man, I didn't realize that overbought could keep going. This one would have been outside of its BigTrends bands the whole way. And the key is that all the indicators came on, and this third leg of the stool, the ADX, also signaled in here right at the close of this bar. So we bought it off this next bar's open, about 15.5-ish. So 15.5, what did we buy? We bought a 16 strike call going out to the June, third Friday of June. We buy the monthly options with this strategy. We don't mess with the weekly options in this particular approach because we're using daily charts and we want to give it enough time. Often a daily chart could take anywhere from a few days to a few weeks to play out, for better or for worse. So the key is that, okay, we're buying it in there. And I thought the options were particularly cheap. Look, we're paying for just a half point out of the money on a name that's highly shorted. A lot of people are betting against it. It's already starting to pick up. It's already gone from 14 to 15 and a half. And I'm going, okay, just buying about a half point out of the money is 16 strikes with you can see in this case about 3.5 weeks ago before expiration, we're basically only paying 70 cents. So theoretically our break even is 16.70 at expiration. But in this case, you see it got up to about 18.50 and we got 100 and 200% and almost got up to about 250%, almost 270 on the max, and then we ended up seeing it come back down, and that's why we sold the last piece at 155. We've got some trailing stop rules where we don't want to give back too much profit, even when the indicators haven't rolled over yet. You don't want to see that you're giving back too much profit in a move. That's just good money management, good trading sense to say, hang on to a chunk of your dollars if you've got a healthy profit and it gives back too much of that. So we've got some trailing stop rules that we teach our subscribers along the way. But one of the things I'll get into is that I don't use price stops in the first 5 bars until I get into a healthy profit position, at least a double. So I don't want to get shaken out of a trade that's with me or particularly against me initially if it's just going through a normal little retracement. So here's one with the BigTrends bands. Here's Facebook. You can see there's 1 and 2 closes above there. The first one, remember, we've got that first one's what I call the setup. It's got to close above there. It did the very next bar. Why do we wait one more bar? Because we were waiting for the other indicators to come on board and confirm. And then as it turned out, we bought it right as it gapped down this next morning, right into, or even a hair under the BigTrends band, because we said, there's our classic percent R retest. That is a beautiful spot to bet that, hey, if this trend's going to keep going, that low should hold. If it closes below that in a future day, we got to hop out of there. Okay. So we know we've got a good risk reward entry here when the Facebook pulled back into the 280-ish range. And you can see, what were we buying around 280? We were buying out about a month to the third Friday in April 320 calls. And again, subscribers will say, well, how do you expect to get paid until it gets to 320? You need 40 points to the upside. I say, no, you just need a quick move. Speed of movement is the key with options buying. If you haven't noticed, if you've ever had the experience of buying an option, being right on the stock after grinding higher for a period of weeks or months or however long you bought it for on the option, and you say, gee, it moved up, but yeah, I lost money in the option. That's because you didn't have speed. You had some direction, but not enough. So, and we don't advise buying these right in front of earnings. We're not playing on events in this particular strategy. We're playing on trends that are developing, essentially the money flow that's happening. All these indicators are going overbought, staying overbought, and the ADX is trending. ADX trending, that green line says we're in a uptrend. This is a positive above a negative there. So let's go and talk about a couple of principles here. One is that I see a lot of traders who, as Babe Ruth said, are letting fear stand in their way. The fear of loss is standing in a lot of traders' way of actually taking swings when you get your quote, as Warren Buffett would say, your quote, fat pitch. Warren Buffett says the great thing about investing is you don't have to swing at every pitch. You don't have to swing at every signal, every little blip on your screen. You can wait for when things really line up. And that's what I'm doing here. I'm lining up not 1, not 2, but all 3 of the indicators together to say that's going to lead to a more powerful chance at a home run and a big at least get a good healthy game to get started and then control the risk from there. So, but the interesting thing to me is, I remember sitting with my dad and watching Hank Aaron hit his 715th homer in the 70s for the Atlanta Braves live, and what an amazing experience that was to see that record broken of the Braves. He had 714 career home runs, but at the same time, he had almost twice as many strikeouts. That didn't prevent him from being a 6-time World Series champion. Of course, one of the iconic figures in the game especially when you think of home run hitters. And he said, I hit big or I miss big. We would like to try to eliminate the miss big part when we can. But the reality is, let's face it, we're buying out of the money options. Some of these might not fire, but that's where we're going to talk about the time stop principle and saying we can salvage some value if it's not working after a period of days, and what I call a time stop rather than a price stop. But this fear factor, I got to talk about this for a second. Fear is what's holding a lot of traders back. One of your ways that you're doing the right thing today is you're educating yourself about strategies that make sense to you that you can implement, and then you can follow along, whether you're doing the work yourself or whether you're using somebody like BigTrends to call out the trades for you in real time and say, buy this option at this price, and then never leave you hanging. Get out of this option at this price for better or for worse. We never leave our subscribers hanging. You always know where every trade stands. But the key is that, to me, that eliminates a lot of fear. Then you're just letting the system play out. I do ask people from the new subscriber side to say, start small, get a feel for how these things move on when they're working, when they're not, and getting comfortable that you can handle that risk, so that fear won't prevent you from executing when you need to get in, or more importantly, when you need to get out. It's always easy to get in. It's hard to get out for a lot of people. With us, it's not, because it's just systematic. But this is really key. We're not trying to live big, although with more money in your pocket, it obviously creates a lot of opportunities for you to enhance your lifestyle, support interests that you would like to support, to enjoy life, to fund education for kids or grandkids, to retire and buy another home, have a nicer vacation, a nicer cruise, a nicer whatever, obviously nicer toys. Bottom line is that it gives you a lot of options. And so it doesn't guarantee happiness, but sure helps to give you a chance to achieve more of your goals in life. So that's important. So the idea here is that, okay, look at AZN. All these times before, like AZN was bumping up into the BigTrends bands here. This is AstraZeneca, another vaccine company. Of course, it's a multi-drug maker company, but they got into the vaccine biz last year as well. And you can see that this one was just starting to break out of those bands. And actually, we're getting intraday strength to supplement what we're seeing with the ADX just starting to trend, with the %R just starting to get going. And the CCI was already going from the prior bar and confirmed. So we're like, okay, look, they've got their COVID trial results due that following Monday. This was on a Wednesday. So we get in there on that Wednesday. Again, the stock's trading about $58. We're buying the 65 strike calls. You go, whoa, that's like 15% of the money. We paid 83 cents. That's $83 a contract. So even, I always tell my subscribers, even if you're a smaller trader and you say, okay, I'm going to try 4 contracts at a time, what would it cost you to try this with 4 contracts? Because you want to get at least 4 to sell the half of the 2 of the 4, and then the 1 and the 1 at the different targets. So if you get 4 contracts for $83 a piece, you can do the math. You're at $332 plus a few dollars of commissions. So $335 roughly. You're saying, okay, if we're at $335, look at what happens. We get that back with a double there just a couple of days later as it pops. And notice where it pops from. It pops from about 58 up to about 61 when we get our first 2 targets, because people are starting to get aware of, oh, this thing's going to come out with its COVID results over the weekend. And so at 61, we sold that second piece right before the bell rang on Friday. And some subscribers asked, why do we sell the rest? Because I said, we want to give it a chance to go. We've already gotten our money out of this trade. When it gaps up and then keeps going, when intraday it's up to 64, we're selling out right off of the open or just after at a 357% gain on that last piece. You say, well, that was great news that they announced in their study. Why didn't the stock keep going up? The BigTrends bands look good. It was closing above those BigTrends bands. You can see even on this second consolidation day, you can even see how it closed back above that BigTrends band at the close. And that's the key. At the close, you don't want to overreact intraday. But the point is, okay, then sell the news. Even the big institutions know that once that news hits, it's probably going to go through a cooling off phase, even if it's great news, even though people are going to come back to it at some point. And you can see it basically retraced all the way back to the prior breakout high in here. That old high became new support in the mid 50s. But the point was, you got to, as a short-term trader, be willing to sell into that news and take your profits there. So we're going to talk more about the BigTrends bands, but I want to talk about these supplemental supporting indicators. The CCI, Commodity Channel Index, sounds like we're trading futures, but actually I use it a lot on growth stocks. I showed that a lot of growth stocks follow the same CCI overbought, staying overbought pattern. So that's probably the biggest eye-opener for a lot of folks here would be that, okay, I like overbought markets because I believe that when they keep going, that the institutions are buying, and they're basically willing to buy at practically any price. Will buy each dip if it's a good trend in motion. So they want to be a part of that. They want to make money like you and I do. So the CCI is different from a lot of other indicators in that it was developed for futures, but it's developed based on not just closes, but Lambert said, take the high plus the low plus the close, add those three data points together and divide them by 3 to create the what he called the typical price for that bar. So obviously, if you're closing at the high, then the close equals the high. So it's like 2 highs and a low divided by 3 is going to have you a weight to the upside. Closes at the low, 2 lows and a high is going to average down below the midpoint and be pulling that indicator down. You average those out over enough days or enough bars that you're looking back at, and it starts to show that this pattern develops. And I didn't even read all Lambert's work at first when I saw this pattern, how well it was testing and trading. And then I went back and reread some of his observations, and he was doing the same thing. So when you look at this chart, and we'll talk about ADX here for a second, so we can kind of put all the pieces together. ADX, of course, is Wells Wilder's average directional movement indicator. This is a trend indicator. You've got a positive directional movement, which is essentially the net new highs, and a negative directional movement, which is the net new lows. So if you're getting more new highs and less new lows, then that means ADX is going to rise because it's going to be picking up that there's a trend in motion, obviously an uptrend in that example. But ADX can also rise in a downtrend if you're getting no new highs and lots of new lows, right? So ADX is really a great trend following indicator. So you put the pieces together on another AZN trade. We've got percent R in here. Again, if it's staying overbought, you can bet it's above the BigTrends bands because that's above that 80th percentile. It would have crossed the BigTrends band right here, and then it would have confirmed it 2 days later right there. So that's the percent R, and intraday, it would have even tested it right in here, but you see how it reversed back up, stayed overbought that entire period. We didn't get on this trade until all the indicators came on because CCI was also, it's in yellow here. So CCI here had broken out a little after percent R, but the ADX didn't come on board until we kicked into gear here on the 14th, and we bought it early on the 17th, that next Monday morning. Stock's trading about 55.5. We're buying a 57.5 call, 2 points out of the money, paying just 69 cents. So right away, 69 bucks, almost 70 bucks, we know, okay, if it goes from 70-ish up to 140-ish, and that's where we sold it at 140 on the first half, that's why it's slightly above 100% because we bought it at 69, sold at 1.4, 102.9% gain. We're going to feel pretty good about it. This is one where, unfortunately, it didn't follow through. The second half, we had to stop in and break even. They actually filled us a hair under that, and we got out at minus 1.5% on the second half. So we still averaged 50%, 51% on the whole trade. So the goal of this is to say, okay, when that happens, it gives back too much. We're saying that's not the right kind of breakaway pattern to keep staying with, even though the indicators had looked like they were hanging in at first. Just time to move on. You see it just flattened out for the next couple of weeks. So the beauty of this is, like, when you see BigTrends bands, to me, the word on here, see, visualization is so important. In the old days, I'd say, well, percent R staying overbought. When it goes above this high here and it keeps going up, it's telling me the institutions want to get on this trade. You need to be getting ready to watch the rocket ship here. When our other indicators confirm, we got on a couple bars later. And I kept it red here because you can see it stays overbought in that top 20% of its signals. The entire phase. Why would percent R stay in the top 20% of its readings the whole way? It's supposed to be a percent range indicator, right? Is it a range anymore? Obviously not. So essentially, when it is a range, you can see the BigTrends band, the light blue and the gray one in this example, is staying in that trading range, chop city. And essentially, I can say put X's through that. You don't want to trade that. Forget about it. It's a bunch of noise, a bunch of confusion, a bunch of uncertainty that you don't need to put those question marks in your head of saying, I'm just not going to even look at those examples. My scans won't pick that up. They will literally look past it and only make me look at the ones where all three indicators are lining up together. But you can see we got into Baidu after it broke out. Now, some criticize a trend following method and say, "Oh, that's just sell high and then buy high and hope to sell even higher," right? But the thought is, you know what? If institutions are just like you and me, they want more of a good thing and less of a bad thing. They're going to keep piling on through that growth phase because they're saying, "Hey, I'm missing out on this. I need to get a piece of this move." This is one example where we did leave some money on the table by taking 100, 200, and 300% targets in just 4 trading days. And I just remind people, don't be greedy. If it does keep going, great for somebody else. But a lot of these times, you'll see that they will reverse, and you're glad that you've taken your profits and gotten back to the sidelines, moved on to the next opportunity. So it's real important to stay discipline. But Larry Williams developed percent R. Now I've got all three of the indicators lined up here. So you can see in this example, ADX signaled before the others. Then CCI was signaling after. There's our percent R BigTrends breakout of the BigTrends band right there. And then CCI came in the very next bar, and then it closed above it on the next bar. So all three systems go there. We're buying the next bars open in here and getting into the 210 calls, which were, 30 or 40 points out of the money. And we weren't worried about it because look at the acceleration that's happening here. This thing is just charging ahead, higher and higher highs. ADX is going berserk to the upside with this perpetual kind of a line up here on the green line, but also CCI and percent R staying overbought. Glad to be able to book a chunk of that profit. Now, brief talk about the Greeks. The one that we're most concerned about when we buy options is theta. That's the time erosion piece, right? And I'm going to get into my time stop philosophy on the next slide, because you don't want to hang around too long, but you got to give it a chance. You don't want to get whipped out of an overall good structure, good indicator setup position just because of a brief little shakeout, which we've seen even in these markets in the last couple of days, where we shook down on Monday, then we've roared back the last 2 days after that fear Monday about the Delta variant of COVID, right? So point is, okay, when I started trading, I put a lot of energy into trading higher delta options, what I would call more in the money stock substitutes. I was building my capital. I was getting ready to launch BigTrends in the late 90s. Want to make sure that I kept a very stable kind of an equity curve to keep building it up, and made enough where I could say bye-bye to my past job and go take those profits and roll them into showing other people how to do it at BigTrends, which, is still something where people look over my shoulder every week and see what I'm trading and how I'm making money so they can do the same thing. But, the bottom line here is that, okay, when you get a high delta situation, $1 change in the stock, if it goes in your favor $1 and your option goes up 80 cents, that's an 80 delta. It can only be up to 100%, right? It could be down in the single digits, and that would not give you much bang for your buck on a 1-point move. Here are the deltas on these Grand Slam options would probably be in the neighborhood of about 25, 30%, maybe 35% as we get them started. Those are out of the money options. Usually an at the money option will move on up to about a 50 delta, which means that on each point, we're starting to pick up a little bit more delta. And what gamma shows you, that's what we really care about. We care about here. We're not trading Vega, which is more of an right ahead of events or like earnings. Gamma would be how fast you pick up deltas. If you buy it too deep in the money, you're not going to pick up any deltas on the next second point or third point or fourth point after that. So, now these days, I really focus more on high gamma options to get the best bang for my buck. And as a result, I'll say, okay, that'll usually be the out of the money option that can go to at the money fairly quickly. Let's look at an example of that. So Morgan Stanley, and this is the time stop I want to talk about. So this shows the BigTrends bands. You can see there's the first close above there on that latest move. That prior one did not signal. And by the way, if it tries to set up and comes back underneath that on percent R, I just turn off the setup and it's got to reset up. So the new setup happens there. I was May 26th, and then the next bar closed above it May 27th. So we're all systems go right there. So we're buying right off of this next open here. Notice, not very good on an intraday or next couple of days basis. We buy there. In fact, that pullback that day drops us down about 50% on the option. Not good for our first day start, right? That's creating that retest I was just telling you about. And it's coming right into that retest level. The next day trades below, but it looks like it closes right back on it, give or take. And you see, so count the days with me from the time we got it. 1, 2, 3, 4, and here's 5. At day 5, we're right back to where we were. Okay, so now it's crunch time. If we're in negative territory after day 5, we're getting out. Day 6, we're going into positive territory. Remember, we bought a 49 call when the stock was trading about 47. It dropped down to 44. You thought, oh no, it's down about 60 or 65% at its worst. We don't sell it because we're waiting for the 5-day time stop rule. 6th day, we're now making money. 7th day, we gap up and we say, thank you very much. We're selling soon after that open. And we were actually kind of taking a little bit different targets here because we're like, hey, our combined profit as we trail our stops here, and our last one got trailed as it came back off intraday, still averaged a 220% gain on the whole position. So the beauty of this is that, and that took 7 days. Now think about it. If you took a 50% loss and said, okay, you felt good for a little bit when it was down 2/3, and saying, okay, that was a smart thing to do, right? No, not. If you're taking a 50% loss to try to save 100% loss, you're saving 50 percentage points. But in this example, if you took minus 50, you could have been at plus 220. You just cost yourself 270 percentage points. You would have to save like 5.5 more trades just to make that wash out to be a break even on that strategy for having missed the one big turn and flip. So the indicators were still bullish, and we don't want to get shaken out by that brief little, sometimes that happens off of breakouts where you buy a breakout and then you've got to go through a little retracement. But the structure of the trend was still very bullish. So it's important that you know that price stops are not something we advocate for this kind of a strategy. We advocate it just about everywhere else across our BigTrends systems, but the reality is, for the aggressive option buyer, price stops usually hurt you more than help you. So just consider that the option, it starts small, and consider the option price you're paying is essentially the premium you're paying is your stop. If you think of it that way, so it could be a lot less risk than buying the individual stock. Here was a riskier stock, Zoom, that had come down into what we call a CCI retest right here a couple days before we got in. And it was hugging that retest and that lower BigTrends band. We're saying we think that the risk reward is pretty good on this trade. Bad news. Microsoft and Google are talking about they're not using Zoom anymore. Well, guess why? Because they have competing products or want to have competing products, right? So we weren't too worried about that. And I was saying, look, it's a make or break kind of a level for Zoom. It should hold. It should bounce. We bought at 115. We bought the 200 strike calls for $1. It sounds obscene, right? But Zoom had an incredible move in the first pandemic leg. And so after about 6 days, we got 100 and 200% gain as it ran. Notice where it stopped, at the upper BigTrends band here, the blue line. So this was kind of an unusual one. And the percent R showed it as more of kind of a trading range play, but CCI showed it as more of a bullish retest still in a bigger trend. So we caught it from 115 up to 150 to 155, took 100 and 200%. And then when it started to roll over, we took 117% on the last piece in 7 trading days. It dropped off, then it rallied more, then it dropped off. It's one of those that we're just happy to take that money and run to the next opportunity. As I said before, time is your biggest enemy as an options buyer. Couple rules on time that I like to use for grand sum options. You could say, well, how far out do you want to buy before expiration? Do you want to buy all the way out here to 120 days? A lot of people say, well, the time erosion over those next 30 days is the smallest sliver, right? If you buy 30 days in, you can see the time erosion overall is a lot bigger. We like to buy somewhere in that 30 to 40 day window, because if you see that sliver of time here, say this is whatever, 35 days in here, and you say that you're losing this sliver of time right here. If you color it in, you say, okay, I lost a little bit of time. But why would I want to do that? Why would I not want to buy the 120-day option? Because you're guaranteeing yourself that you're getting an earnings cycle in there every 90 days. So you're going to be paying for earnings volatility. You're going to be paying up for the options. It's going to really reduce your leverage and not allow you as easy of a time of buying a $1 option. You have to go way further out of the money and count on a much bigger move than what we need. The other rule that I would say is that, okay, and we know after 5 days, if it's not working, we can cut and run and move on. The other thing I would say is about 14 days in here, the last 2 weeks of an option, too much decay. We don't want to hold an option in those last 2 weeks. So we will always roll out of any open positions, like say, if it's the August expiration, it's August 20th. Well, that means 2 weeks before that's August 6th. By that Friday, August 6th, which is still, 2 Fridays after today, we would have to be out of all of our August positions. So it's just a good rule of thumb, good way to manage accordingly on how this whole thing works here and what you need to do to be intelligent about holding your position here. So when we think about this, we say, okay, clearly we need to be in this situation here of making sure that we have a clean trend in motion here. So you look at Schlumberger, one of the biggest, if probably the biggest oil service company out there, bigger than Halliburton. A lot of people know Halliburton because of Dick Cheney, who was VP under George W. Bush. But bottom line is that you say, okay, look, this one was going, and then you see that then the ADX came on board here, and all threes were all systems go. BigTrends bands have already broken out once it closed above that overbought bar's high on that second bar after the setup. So you can see here that we've got this situation here in which, staying overbought through that whole phase, nice uptrending channel, CCI in yellow is bullish, ADX is trending up. That's what you want to see. You want to see that ADX driving up here. When we see that, we booked half at the double. Then as it started to roll over, it got up to about 150%, and then it came back down to 56. We said, we just got to go. It's not doing what it should be doing. Essentially, if you were drawing channel lines, you could probably also see that this channel was kind of broken in there too when it popped down there on May the 19th. So you see, okay, we're just moving on at that point. Take the 75% gain on the whole position and say that's good enough for me. So you look over here at some other names we like to trade. If it's Alibaba, Baidu, Microsoft's a popular one with us. That had our biggest gain of all time, some 800% or 750% actually we got on the second half gap after a double. So the beauty of this is that, yeah, you can do really well when you get gaps. And that's the one time I will trade into earnings if I've already sold half of the double well ahead of earnings and I've still got the other half rolling into earnings. Okay. So a lot of these names are great traders, names that, you can really see very quick, fast moves. By the way, Baidu, coming back to Baidu, here's one that we traded tied to an earnings report. And you can see the earnings was on this gap back here about a week before we got in. Then it went through what we would call a wedge pattern here, where it's starting to finally break out of that wedge. And we said, okay, look, ADX is trending up, percent R is good, and then CCI is coming on board, so we can get on board here. And then after about 4 trading days, we took our first 2 targets, or our first target actually at a double. On 6 trading days, day 6 here, we're actually getting both of our targets. Notice what's happening here. The stock was, when we got in, was about 255. We bought the June 290 calls at $1. So as it pops up to 270 and then 275, we're getting our 300% gain. We don't have to get back to the strike price to get our targets. That's a wonderful situation to be in here. Love getting the great feedback from subscribers, especially new ones like Srikanth, who said, great feeling to start the service with a winner, first time over the last year of trying many different services. We can't guarantee that, of course, but we always are motivated to want new subscribers to have just as great of an experience as our existing subscribers have had. A testimonial, but can't guarantee that. But we're always working hard for all of our subscribers. The testimonial here from Robert Romine said, when he began using my %R method, he started to see a lot more success. And he said he almost tripled his total portfolio, more 100 and 200% winners he'd ever had in the past. So, of course, now it's his primary trigger for all of his trades, right? Not surprising. When you have success with something, you want to stick with it. Even Apple, which we did score on Apple here recently for a 300% winner. But this is a past example here with Apple where you can see that, it's breaking out here. Just got the slight confirmation right here. So we got on board on Apple here. And then we went through kind of this first 3-day fizzle. Okay. We're losing money after 3 days. Again, the time stop, the price stop would have flushed us out. But then when they announced this iCar news, and we bought the 145 calls for 88 cents, it dropped against us by about $5 or $6 on those first 3 days. On the 4th day, iCar news popped it on up, and now we got our double in here intraday, 104% on the first half, 4 days later. Once you get that free trade, it makes your life so much easier. Even though the second half didn't do much, we still made healthy money on the trade and just moved on. So I show these examples to remind you that not every trade is a rocket ship to the moon. Some trades give you the chance, though, to cash in, reduce your risk down to nothing, even if the other half crapped out, and saying, okay, at that point, now you can really be a lot freer to give it a chance to turn into one of those big winners. So the catalyst for us has to be present. Typically, it might already have a good earnings reaction and be continuing the trend after earnings, or it might have earnings coming up, not tomorrow. We're not going to trade right in front of that because you're going to pay up for those options, but maybe a week, multiple weeks or a month ahead of earnings, it still could be worth trading. But usually there's technical patterns for institutions that are pouring it on or getting the heck out on puts. We do this with puts too. It's just we've had a lot more call examples in the bull market. Out of the money, by definition, in almost every case, we're going to buy them for $1 or less. We'll never pay more than $1. So that even if you're trading just a 4 contract minimum, you could get started with as little as $400 a trade. So that you don't have to worry about overpaying or getting too much capital into any one trade. It makes your life incredibly easy to say, okay, just real simple approach. and how you can do this. A time stop is a really good innovation for options buyers rather than a price stop. It'll, especially for aggressive options traders, it'll really make your life a lot easier. You don't have to overreact and get flushed out of otherwise good setups. The gradual profit taking is another secret of success. It's not taking it all at once. It's saying kind of gradually taking money as the market makes it available to us, but giving yourself a chance for those bigger winners is how you can more dramatically grow your portfolio. Trade allocation. We don't want to see more than 5 to 10% of the capital that you allocate to trade the Grand Slam option service go into any one trade. I don't want you to say, "Ooh, I really like that one. I'm going to load the boat on it," or "I don't like that one. I'm going to pass on it." Because invariably, what will happen is people that are picking and choosing will then be the ones who are like, "Oh, I picked the wrong ones." We like to say it's a systematic approach to building wealth over time, not expecting to have one trade be the make or break trade. We don't want that. Weekly video training. I'm giving you constant updates about what I see on our positions, what I'm looking at, the positions of the market, the condition of the market, and how it's setting up for us. Notice we're also trading a lot of the big name, including FANG stocks. So when we get the opportunity, because we will focus here on a little bit longer time frame usually, or like Microsoft, not a FANG stock, but maybe should be. But bottom line is that there's our big trends band breakout. You can see it's starting to happen here. We were picking up on an intraday confirmation as well, so we could get in a little earlier. And then look how even when it has a down day here, like on this, you can see this little first rectangle here, how it holds the big trends band, Notice the big trends band is rising. Why is it rising? Because we're getting higher and higher highs, right? As you tag higher and higher highs, the percent range indicators basically picking up that we're expanding the range, right? What is a expanding range also called? A trend, hopefully a big trend, right? So you can see higher highs, higher lows, thus the rising ADX, which is the yellow line here. It's harder to see on this white background, but that ADX is rising there. CCI is rising in yellow too. So but the percent R with the big trends bands, we caught it in that 5-day window, 104 and 206%. The last pieces that rolled over on that 5th day, we said, okay, we can't afford to hang around anymore. We'll take 122% on the rest and be done with the trade. Nothing wrong with that. So really, really sensible. If you came in late, you can see a $5,000 portfolio could have turned into $22,800 and change. Looking out over the past 5.5 years, so that's like 357% total gross before commissions, knowing that commissions are still relatively small impact on your trade. Because whether you're trading 4 contracts or whether you're trading 10 contracts or whatever your choice is, it should be still a relatively minimal impact. So the beauty of this is you say, well, how can you get that growth in your portfolio? Well, let me get to that in a second, because I've got a fantastic offer for you that, David and I have known each other for a long time. So I wanted to make something really special for his group and for all of y'all today. It is, of course, an options recommendation service. Believe it or not, we do get that question. But yeah, we're calling out recommendations for options to when to get in. More importantly, no matter whether it won or lost, we'll always tell you what to do with it, win, lose, or draw. So you know where you stand on every trade all the time. And we send real-time email updates and text alerts when to get in, when to get out. We're buying these out-of-the-money options, no spread, so it keeps your life really simple. Typically, with that 10% capital allocation, I would recommend starting with as little as $4,000 in the account, so that you could do at least a $400 per trade, which would be 10% allocated per trade, which would be about the maximum we would tend to recommend to any subscriber coming in. So that allows you to start small, not have any one trade make or break you, let yourself build. Like we said, you could even buy one contract for as little as $100, but we would like to see you getting into the 4 contract mentality to get the double, triple, quadruple target potentials. Typically about 6 to 8 trades a month. We could be in anywhere from a few days to a few weeks. Real-time email and real-time text alerts. We get that all set up once you become a subscriber. But I'm offering you several bonuses today in addition to the trade alert call-outs in real time. We'll give you my Grand Slam options settings and rules. So everybody's always asking me, well, okay, how long of an ADX, how long of a percent R, how long of a CCI and big trends band, all that stuff. We'll give you that when you become a subscriber. I'll give you weekly video updates every Monday at 6 p.m. And then I'm giving an extra special bonus for my best offer here. I'm going to throw in my Gamma Options digital boot camp. Gives you ongoing access to that no matter what subscription term you buy. So when you add up those pieces, and more importantly, add up, of course, the trade callouts is the biggest part of the value. 12 months would be about 4 grand. I'm giving you an extra special thing though. I'm going to BOGO this. I'm going to add a second year on me and give you 24 months for way under the price of 12. 12 months would cost you on my website like 4 grand. But the point is, when you add all these values up of all the educational bonuses plus all the trade callouts, you're at almost 9 grand in total value. I'm crossing that out for you today and offering it to you for 24 months access plus all the other bonuses for just $997. So what I've done is I've set up this link here. It's members.bigtrends.com/GSO24. So that will get you to a page that looks like this. It's a really simple page. It just says basically, do you want to pay with a credit card? Do you want to pay with PayPal? You already know what this is about. You already know that, you can pay for that. Like I said, if you put in $1,000 on a $1 option, 10 contracts on $1 option, we go and double it from 1,000 to 2,000. There's your $1,000 profit right there. One double, which is just our first target off of one trade, can get you 24 months essentially of gravy off of that one trade. So I like it when one trade can more than easily pay for your total subscription with all the other bonuses. So you see that you can do PayPal, you can do credit card. We do ask you to review our terms and conditions, which are very well spelled out. But more importantly, know that I launched BigTrends in 1999. I've always stood behind my products to make sure you're not just happy, but delighted, because it's that word of mouth that's allowed us to keep growing BigTrends.com over these past 2 decades plus. I'm looking forward to many more to come. You can also email our client care at BigTrends.com email to ask any questions, or if you want to call us toll free, you can call our 1-800-BIG-TRENDS number, which is spelled out there. Just remember 1-800-BIG-TRENDS, and you can reach us anytime when you've got a question about this. So, the principles are, you've got to be well educated and you've got to be patient. You can't afford to be too reactive or hair trigger to what you're doing with any kind of a plan to build your wealth, any kind of a set of trades. The thing that I remind people too is that, look, I've been trading for over 30 years. Like I said, I got into trading in 1990, right after I graduated from Duke, and said, what? Okay, got into trading, made those early mistakes, and I realized I couldn't be discretionary. I had to be systematic, had to follow a system. The nature of a system is that we're trading for a positive edge over time, knowing that we can't predict what any one trade will do. Will it be one of those big winner patterns? Will it be a smaller winner pattern? Will it be a flat or a losing pattern? We don't know that on the front end, obviously, otherwise we wouldn't make those other recommendations if they're not going to be giving us that big win. But the reality is, in order to have that potential, you have to be able to pull the trigger on each of those trades when you get a signal. If you're not following the system, if you're trying to pick and choose, or you're trying to put your own analysis on top of it, then you're basically not letting the system do what it's designed to do, which is to say, let the edge play out. The ones that work, we can keep squeezing more and more juice out of those winners with 100, 200, and 300% targets. And then also knowing that we can also focus in on the 5-day time stop to clean up the trades that aren't working, just salvage what we can at that point. Sometimes they'll be a decent value. Sometimes they might be still a healthy loss. So the thing I remind people too is, when you get started, don't go in all guns blazing. Start small. Like I said, you can start with as little as $4 grand and $400 a trade on 4 contracts, and sometimes even less than that when it's under $1. But the point is, we'll never pay more than $1 or $100 a contract. So you get 4 of those, that's $400 at max per trade. Then you start to get comfortable and start seeing this and looking at this with the 24-month package. It's obviously giving you a ton of time to educate yourself. In addition, like I said, the boot camp training, when I talked about gamma earlier in the 5th year, it made your head spin because it was like the options Greeks. I go into a lot more detail where you can kind of build you up into understanding what I'm trying to kind of convey in an hour. This gives you multiple hours of boot camp training to allow you to really start to truly understand what we're after here with this Grand Slam option strategy. Plus, you get the settings and rules, the weekly videos, and you get past access to it. You go to our members.bigtrends.com/GSO24 page here. It's not a www, so don't get confused there. We kind of tap you in right away to, when you get signed up, you're going to want to go to your members.bigtrends.com site anyway to get your past access to all kinds of great education, great video training, great learning while you're also earning. So maybe I'll pop it back over to David here for a minute to see if we had any other questions maybe that I should pick up before we get ready for our next speaker. Let me see if there's any I need to pick up, David.
Uh, yeah, do you see the chat?
I always have some trouble with that. I see it now. Let me see. Okay, let's see if we got any questions.
Do you ever
here.
trade puts is one of them?
Yeah, absolutely. We do trade puts there. I see Stephanie asked about that. So we trade puts, and puts you've got to be pretty selective. Obviously, in a bull market like we've had, you've had to be very selective. We were successful on making some money during the pandemic. I was really successful going way back into the financial crisis. That's where some of our best gains we ever had were because of how fast the market was crashing on the downside. So you've really got to pick your spots. But I have done it with names that are really rolling over and breaking down. It's one of those that it'll typically make me even more quick to, if it's not immediately moving in my favor, to say I better see that speed of movement on the downside real quick. If it's not there, blow it out. Because you saw what happened on Monday. Monday we got the initial sell down, but it really didn't follow through. It drifted a little lower Monday afternoon, but not that much. And then, of course, we roared right back Tuesday morning, roared back up again today. So you really got to be selective about your put opportunities when you're in a bull market for stocks. So it's definitely put a filter on trading in tune with the market. I guess if that's a final lesson that I might say is that, remember how I said I made those early mistakes in my own trading where I basically was, fighting the market, being a perfectionist, not willing to admit I was wrong, and saying, you know what, that's being out of tune with the market. If you play an out of tune instrument, it sounds terrible and nobody's going to want to listen to it, and you're not going to want to listen to it. You get it in tune, you get yourself in tune with what the market is telling you. You're going to be much more likely to have success, to enjoy the process, to say, okay, I'm catching the flow of trades. The thing that gets a lot of traders in trouble is that they start rationalizing, they start coming up with reasons why they should or shouldn't trade a stock or an option, and saying, well, this stock's too expensive. It's already had a big run. It's already done this, or I'm hearing negative things about it. Actually, I can remember many times being on Fox News and talking about names like Valero. I remember being on there and when Valero was running big to the upside, and they all three of the other panelists all said, no way, it's run too far, no way it can keep going. And the stock went on to double over the next few months. And we've made big money in the options. It's one of those things where it's like, if you see pessimism amid a uptrend, that's what you want to see. That's that proverbial wall of worry. So when we got the spike in fear that we saw in the VIX and other indicators on Monday, we're saying this is the kind of buy the dip and the fear reaction you want to see to say that's likely to be a short-term pullback in a longer-term uptrend. So definitely keep that in mind, that we will trade puts when things line up properly. But right now, of course, the bias has been to the upside. Well, David, I want to say thank you for having me. It's always a pleasure being with you all, and I'll look forward to seeing you again real soon. Thanks so much.